Good morning, everyone. Welcome to this week's episode of Java with Jen and Jess. I am Jennifer Fernandez, and I am a realtor and the branch manager for the Property Pros Tampa office.
And I am Jessica Sherrill, and I am the senior loan officer with Freedom Mortgage, the home team.
Today, we are talking finances. What does financial freedom mean? With us today is two financial advisors from Northwestern Mutual Wealth Management Company that will be answering that question. We're also going to tap into making your money work for you while planning for retirement and leaving a legacy. But first, let's get into this week's Small Business Spotlight.
Yes, we have with us this morning, and we are so excited to invite on Kai, the insurance guy, where he's going to basically go over what he does, what vehicles he actually offers clients and us in the industry, and how this can benefit us financially as well. So Kai, thank you so much for coming, and we are so excited to have you on.
Thank you so much, Jen, for having me. Happy to be here. So I'm excited. I'm Kai, the insurance guy. Easier to remember than my government name, so it's stuck, and we go with that. So I'm an insurance broker. I have a health and life agency where we write health insurance for a lot of self-employed individuals. So we're brokers, Jen and Jess. So pretty much we represent all of the carriers in the state of Florida. And one of the big things that we kind of specialize in is, of course, with a lot of self-employed individuals, they have to purchase their own health insurance because they're not getting it offered to them through a company, et cetera. So we'll work with a lot of them to make sure that they have options, et cetera, and kind of navigate them down whatever is the best route for them to be able to get health insurance for themselves and their families. We also do work with anybody that needs health insurance. Obviously, throughout COVID, there's been a lot of furloughs. So we've been dealing with a lot of that, making sure that as people are losing their benefits, and they're only being offered COBRA through employment, we've been able to step in and make sure that we can either guide them to get on the marketplace or get private coverage, et cetera. So that's what we do on the health side. We do write life insurance as well. And then I own a P&C agency as well. So because of as many realtors as we work with, homeowners insurance became a really big deal. Because of course, as you know, Jen, from doing a lot with me, we work with so many realtors. Most of my clients are in the real estate industry of some sort. So it only made sense for us to begin to write homeowners insurance as well. So we're brokers on that side as well. Own a company called the Morris Insurance Group, and we do the same exact thing on that side.
That's huge. I have a question. As far as the health insurance, is there, not to get into the weeds about it, but how do people reach out in that sense? I mean, is it like a short-term situation as far as the health insurance?
So it really just depends. There's health insurance is kind of broken down into two buckets now. So you either go on what we call the marketplace, which is going to be, it has like 20 different names to confuse the American public. So they'll call it Affordable Care Act, the Exchange, healthcare.gov, Obamacare. You'll hear all those names. It's one thing. It's just a physical exchange where people can get health insurance based on their income. So during open enrollment, or if you have a special enrollment period, you can pick a plan through that. The only thing with that sometimes is that because everything's income driven, if your income just is outside of the income guidelines, the premiums are ridiculously expensive. So that's when we typically like to pivot and then look at sometimes what some of the private options look like. And that's where kind of touch on the point of short term, et cetera. Now it's gotten a lot, more broad. So they even have 3-year plans, 1-year plans, et cetera, but they're not based on your income. So that helps out a lot of individuals who do not qualify for subsidy on the marketplace.
That's good stuff. Good stuff.
Yep.
It's good that you're doing some homeowners insurance as well. As you know, this market is crazy busy, and we need all the referral partners we can have in our circle so that we have support, right?
Oh, absolutely.
So, yeah. So how can people get a hold of Kai, the insurance guy?
I wish I had like a bat signal. People could just start. No, but you can, KaiTheInsuranceGuy.com is actually our website. So if you go to KaiTheInsuranceGuy.com, everything is there in terms of what we do, booking an appointment, etc. My email is super simple as well, Jen and Jess. So it's just Kai, KY, at KaiTheInsuranceGuy.com. And then my phone number is 407-451-8756. And I'm pretty big on, not big like too popular, but I'm on social media a lot. So Facebook, Instagram, if you just type in Kai, the insurance guy, it'll take you to one of our pages. That's going to be the way to get started.
And do you help those, if you're need health insurance and life insurance, do you offer consultations to where somebody can reach out to you and figure out? I wouldn't know where to start trying to figure out what life insurance plan I should get and how much coverage I should get. So if somebody like me came to you, you could put me in the right direction.
100%. Yeah, we have a pretty, I'm really excited about our process. So for years, for 5 years, we've been doing something, just we fact find. And, so we go through it, everything. One thing we understand about health insurance, life insurance, home, all of the insurance space is it's not one size fits all. That's far from the truth. And your needs could be completely different. And even though you guys are close and friends, right? So, we like to go through that, through a process and then kind of present some different options that can make sense for you guys.
Awesome.
Yep.
Awesome. Well, thank you so much for being here and taking the time. I know you're a busy guy.
That's cool.
So thank you so much for being here with us today. And
thank you so much for having me, guys. I really appreciate it.
Yeah, we look forward to seeing you soon.
Absolutely. Yeah. Fun with the Felipe and them. Those are great guys.
Have a great weekend, guys.
All right.
Bye. And without further ado, we now bring on Felipe and Willie with Northwestern Mutual. Good morning, guys. How are you?
Good morning. Good morning.
So, as we all know, the topic of today's show is financial planning for your financial freedom. So, I kind of want to start out in the beginning with you guys giving us a little bit about you. How long have you been in the business, and just anything about you?
So we've been in business since 2013. We've been working directly with Northwestern Mutual as our broker dealer. When you're with Northwestern Mutual, you also have access to certain insurance products with them, especially the disability insurance policies, the long-term care, and the life insurance policies. But we are contracted with brokers too, so we are able to offer basically any product out there. And that is just part of our fiduciary responsibility as a wealth management advisor. And so we're here in Lake Nona, Orlando, Florida. We have an office in downtown Orlando, and we also have one here in Lake Nona. We're both residents of the Lake Nona area, so we would like to stay more in Lake Nona than in downtown, especially with the traffic. So we're excited to expand and to serve not just the Lake Nona area, but basically anyone out there that needs our help.
Okay. So anyone in this, are you licensed in the state of Florida? How does your license work?
So we're licensed in a couple of states: New York, Florida, Texas, California, Washington, Colorado, Georgia. So and then if we get referred to a client in a state that we're not licensed yet, it's
really simple.
Yeah, it's a couple of weeks process for us to obtain the license.
Well, let's start out. What is a financial advisor?
Want to chime in on that?
What a financial advisor is like. It's like when you go to when we meet up the first meeting, is when you put an address on the GPS and you wanna go somewhere, right? And we just guide you and take you routes. And if you take a detour, we try to put you back on that route that will take you into financial freedom at some point in your career or retirement or however that person wants that terminology to be.
A pretty philosophical explanation there.
So what do you guys?
The way that I would, very quick, the way I would define it more technical words, I would say, a good financial advisor will be licensed with certain insurance licenses, like the 215 license, for example, and then also being licensed with their series, which is the Series 6, 63, 7. In my case, the 26. That one is not really required, but it is for supervision purposes. And then there's a website, if you ever want to check how, if there's any background on a financial advisor, you always want to go to brokerscheck.com, and you can type whoever is talking to you, and you can check their background, whether, they have any complaints against them, or if they, how many licenses do they have, which states are they licensed at.
That's good feedback. What do you guys love about being financial advisors? What do you love about that?
Start.
It's just when I first started, I found a passion of seeing how successful a business or a family, and when you receive that text message from someone 3 years from now, thank you, Willie, thank you, Felipe. I see you growing in your career, but as well I'm growing, and thank you that you persuade so much into that first meeting. I was saying no to that first meeting, but thank you for persuading me into what you do as a financial advisor. I think for me, from my experience.
Yeah, similar to that, I would say, I'm a frustrated architect. I originally wanted to be an architect, and since I was very little. But unfortunately, when I was going to UCF, they didn't have the architectural degree available. So I went with finance. I've always liked money. And so I went with finance. And what I realized now as a financial advisor for all these years is it's kind of like being an architect, right? Like you're there with your clients and you're drafting a plan and you're trying to figure out, mathematically speaking, how to get to certain financial goals that they have and how to take care of their family financially in case they're not here. And it's kind of nice to see it done, right? Like we've been practicing, like I said, since 2013. So a lot of the clients that we met back then, today they're retiring because of what we did back then and the plan that we set up. And it's kind of cool to see it done, right? Another thing that I love about my career is the stories. I'm a storyteller myself, and I love hearing stories. And I love when I meet with someone, and my first question usually is like, tell me your story, and it's just great to know so many success stories out in the community. And I think that's what motivates us to keep going and to keep reaching out to the community, just to hear more of those stories. It's very rewarding, I would say.
Yeah, definitely.
Love it. So let's jump into the meat of this interview. Let's start with the biggest question that we're advertising here. What does financial freedom mean to you guys, in your opinion?
Financial freedom. It's really simple. It's just when your net worth is generating sufficient income where you can replace your income with passive income. That's
Yeah, a little bit more technical analysis there. I would say it's, you start in life by earning income, right? And unfortunately, nobody really teaches us, in high school or even college, that nobody teaches you how to move from earn your income to make your income with assets, right? And I think financial freedom is defined by, moving from one quadrant, which is the earned income, to the other quadrant, which is basically, having assets that are producing and replacing the income that you need to sustain your life and your lifestyle.
Okay. What is the first step towards that financial plan? What is the first steps that a person should make or should take when financial planning?
Besides calling you guys.
Besides that, right, exactly.
I think the first step into financial planning is creating a foundation. It's like when you're building a house, especially you guys probably know more about this than me, but when you're building a house, you put everything, I don't know how to say it, but you put everything gets flat, then it comes to concrete. So I think the first step is to see your balance sheet, create an emergency fund. That's our main priority when we meet up with people. Hey, do you have sufficient cash that will last you 6 months to a year from now? In case something happens. And the worst case scenario, we just saw it happening in March, COVID, right?
Right.
I mean, and I would say that the very first step is to earn income, right? That's definitely you gotta have some sort of cash flow, right? There's most of you probably have read the book, Rich Dad Poor Dad by Kiyosaki, and it's a cash flow game, right? It's you gotta get the cash flow from somewhere, and of course, if you're just getting started, you gotta get some sort of career or some sort of job going that it's allowing you to not only have enough cash flow where you're paying your bills, but also having enough cash flow where you're paying your bills and you're also saving money, right? Because in order for you to invest any money, you gotta have savings, right? So then you have savings, and then those savings you can invest, and then you can also leverage with banks' money or lending money, borrowing money for you to do the projects you want to do. And that's called entrepreneurship, right? That's whenever you're taking risk to build something not for only for yourself but also for the world, that's entrepreneurship right there.
So what would you say is some of the common mistakes that people make when starting out this journey to financial planning?
I would say the common mistake, it's a general mistake done, which is not budgeting correctly, right? That's we see it all the time, right? People come to us, people making 100,000, like people making $1 million. They all have the same problem. It's budgeting correctly. It's knowing that money's coming to you because of your hard work. And then it's if you keep spending 100% of the cash flow, you're cash flow neutral every single year. And if you keep doing that for 10 years, you're always going to be at zero. 0 times $1 million is always 0, right? So you have to budget in a way where you're not overspending or you're not just at zero cash flow every year. You gotta have that cushion, that separation between bills and actual income, so that way you can have that savings that you can put on your balance sheet, right? So the only way you grow your balance sheet or your network, like a lot of people call it, is that if you have a positive cash flow at the end of the year, that positive cash flow should go into your balance sheet. Now, some people translate that into cars. Some people translate that into real estate, into savings account, equities, fixed income. I mean, many different assets that are out there. And some people make money buying cars and selling cars, right? I personally am dumb when it comes to that, right? So I try to keep it very simple. I lease my cars, and I let the dealership take the depreciation hit on that, and I'll just get a deduction on the lease payment, right? Because again, I'm really done with cars. If my car breaks down and I take it to a mechanic, they can sell me anything they want, and I'll just say yes to. So I keep it very simple, right? But some other people are very good with cars, and they make money flipping them. So there's no right or wrong answer with those type of things. It's just a matter of how you feel comfortable. As long as you have positive cash flows and your negative cash flows are below those, and there's always extra money going towards your balance sheet.
Okay.
That's really, really, really good information, because I've, in my business, I see a lot of clients, and, if they have $150,000 that they're making a year and they can't even pay their bills, there's a budget problem, right? There's no positive cash flow, as you're saying. So the person making $30,000 could be more wealthy than the person making $150,000. So it's really not about how much money you make. It's about how much money you have left over after you make the money, right? So that's really good insight for a lot of people, because I feel like, and I was even, caught up in this as myself. A lot of people focus on how much money they make per year. It really doesn't, that's irrelevant. Mm-hmm. It's how much money you can take home after that salary. So it's changing that mindset is really important. And that's, I believe, in my situation, it was the first step in valuing money, valuing, putting a value on how much money you make. So give us some tips and ways to generate some passive income. Because I think that, a lot of people are like, well, to generate passive income, I have, buying real estate, like that's the number one thing that people think of. But, what other ways and have you seen that are successful in generating passive income?
So I'm very intrigued by, extremely wealthy people in the world. And one thing that I can say is if you want to learn what wealthy people are doing, just look at the top 100 list and look at where their money is allocated. And what you'll find is that their money is not allocated on one place. Their money is diversified. And the reason is because there's market shifts on every industry at any given time. And you always want to be compensating one with another, right? So what I would say is, to keep it simple, passive income can be generated from real estate, of course, like most of us know. Secondly, dividend payments. So any type of corporation that you own and that is being solely managed by a group of board members and management team, and all you're getting is just dividends from that
every year.
And that can be a small corporation, a local small corporation that you're just part shareholder, or that could be a massive corporation like Apple that you just own stock there. Unfortunately, though, technology companies are not really good at paying dividends. They give back over value of their stocks over time, right? So if you're looking for passive income in the stock market, you would just want to go for dividend-paying stocks, right? And another place where you can have some passive income coming from is interest rates, like being a lender, basically. And when I say being a lender, I'm not saying lending money to your friends and getting an interest rate. I'm not, I mean, that could work too, right? But not I would say buying bonds, buying municipalities, buying any type of debt instrument out there where you're lending money and getting an interest rate in the back. Now, of course, in today's world, in today's environment, financial advisors were having a really, really hard time with that because interest rates are extremely low. So when people come to us saying, hey, here's $1 million, I want income from it, it's becoming harder and harder to provide that income because interest rates are extremely low right now. You're averaging between 2% and 3% per year on monies like that. So we're at the stage now where if people want distribution from their liquid assets, we're in an environment where we need to be very careful on how we manage that money. So that's why you need to have a diversified portfolio. Most financial advisors out there, are very against real estate, or they'll just talk down on real estate. And it's a money thing, right? It's, of course, if you have $1 million, you put it in real estate. Financial advisors don't make money on real estate. We make money on managing that asset portfolio for our clients. So most, financial advisors out there, of course, are going to be against it because money is not on their side of the table. I'm a little bit different. I believe in financial planning. So when you're looking at financial planning, real estate, I'm a little bit of an agnostic, right? Like, to me, money is green. Money doesn't have color. And so if I can generate a 5% rate of return on my portfolio over here, and real estate is at a place where it's giving me a 12% rate of return, I am moving my money there, right? So I'm always looking for, what's going to give me the best rate of return, but also measuring the risk adversity of it, right? And again, I said that earlier, I'm not the type of person that put all my eggs in one basket. I'm always looking for diversification, right? Like myself, I have money in the stock market. I have money in my life insurance policies. I have money in real estate. And now I'm getting into buying businesses, right? Because I see that the economy is flourishing. And, even though in the situation that we're in right now, I think things are going to get better as we progress. People are in a positive note. We're all human, and I think humanity in general for many decades, we've come together and get out of these situations by helping each other and making business just flourish no matter what happens. So I'm staying positive and optimistic. So there's certain industries that are just gonna keep flourishing, and I'm moving some of my monies to those industries, right?
Yeah. So is that part of your services? When a client comes to you, do you kind of keep an eye on the market and the different things that are and advise your clients, hey, this is happening over here. Let's maybe look into this avenue instead of where we are.
Correct.
Yeah.
Yep. And like I said, I mean, we're fiduciaries, so at the end of the day, we're just looking at mathematics here, right?
Yeah.
It's one thing is product selling, and I, we take our job very serious when it comes to here's our fiduciary role, here's our sales job, right? And there's certain financial products that we can bring to the table to our clients that will help them very well. But if those financial products are not matching with what the client is telling us, where they want to go, and mathematically speaking, these products won't fit that, we won't bring them to the table. Because again, there is a line when it comes to our fiduciary responsibility.
Okay. So as both of us, as an agent and as a loan officer, we have clients all the time that ask us, should I pay down my debts or should I continue to save money? What is your opinion on that? Do we get all of our credit cards down to that zero balance, or do we save that money and have enter a savings account somewhere?
It's interesting because there's no right or wrong answer, right? I think accountants and financial advisors, it's like even back in school, we don't get along too much because accountants are down to earth. 2 + 2 is 4. Financial advisors, like people that do finance like ourselves, we're always projecting to the future and we're speculating. It's called speculation. So we use statistics, we use probability to try to speculate as accurately as we can, but there's never 100% correct answer. So what I would say to that question is, it really depends on the client, right? If the client is an extremely risk-averse individual, paying down debt will probably be the best route for that individual client. But then if we're talking to an entrepreneur, someone that is taking risk on a daily basis, most likely for that person, it's a lot better to just leverage. And when we talk about leverage is, if you have a mortgage at 3% interest rate and you have some, let's just say $100,000 in your pocket, it's probably going to be a lot better for you to grab that $100,000 and invest it in anything that is generating a 3% or more rate of return. Because mortgages, when you're paying the 3%, I don't know if you've ever calculated this, but when you're paying interest rate on a mortgage, first of all, that's a 30-year mortgage. So over that 30 years, you're paying that 3% every year on a different principal every single year, right? Because it's amortized. So in reality, when you grab how much interest you actually paid on that mortgage and you divide it by all those 30 years, the 3% interest rate is actually a lower interest rate over time because it's calling a depreciated interest, right? Because you're paying it down. But when you invest money, especially if the 3% or more, it's compounding over time, you're getting interest rate upon interest rates. So when you create a compound effect, the 3% compounded effect, it actually becomes higher over a 30-year period, right? So when you do the financial analysis, and again, we go back to mathematics, right? That's our job here with Willie. It's we grab those scenarios that you were just saying, and we just do mathematics. There's no product involvement in those mathematics. It's literally just math. And when you do the financial math on it, financially speaking, it's a lot better to put that money to work at a higher interest rate than the mortgage that you got into.
Which completely answers my next question. I had a client that actually owned a home, very interested in purchasing a new one. Financial advisor said, borrow funds to improve the home versus, doing what they thought they were going to do is, purchase a new home. You kind of just answered that question as far as, not taking money out of the vehicle that's compounding interest, but, staying where they are. So that makes sense why you kind of said that.
Well,
so
it depends too, right? I think there's no cookie cutting answer for that.
Right. Right.
For example, I can tell you my personal experience over the past 2 years. So I've been living in a house in Lake Nona, older house, it was built in 2006, comfortable house, right? But it was a 4-bedroom house. And then my kids are getting older. So we kind of felt like, hey, I feel like we need a little bit of a bigger house at this point, especially if we're going to have a third one coming on the way. So we basically said,
Did he just make an announcement? Yeah. Live on John.
Okay, so not yet. Okay. So my wife is a mathematician, so you can only imagine the late night conversations I get with my wife. It's pretty fun though, and it literally took us like a whole year to make this decision. But it made a lot of sense for us to move the equity from that one house to the next house, to avoid EMI and a couple of certain other things. So of course, the cash flow wise, we were paying this, and then on the new house, we're paying this. And the way we compensated that is that we invested in a garage apartment here in Lake Nona. And then because of that garage apartment, now cash flow wise, we're cash flow neutral with the mortgage that we were before. Because again, we go back to the same principle. My wife and I were always looking at cash flow first, and how can we always be cash flow positive so that our balance keeps growing on the side, right? And
no matter what decision.
Scary, but at the same time, cash flow wise made a lot of sense. And the house that we purchased, it's probably going to have a lot more appreciation than the house that was built in 2006, right? Lake Nona is a very new area, so we thought to ourselves, well, if someone comes to this area, they're going to want to buy a new house instead of that 2006 home. So I think we got out of the marketing the perfect timing from that house, and we purchased this new house over here.
That's fascinating. Awesome.
Let's switch a little bit over into 401ks. Maybe start out, for those who don't know, what is a 401k, and is that something that somebody should save money into?
Yeah. So let's first get rid of skeptics, right? I have people come to my office all the time asking me, but I've heard putting money in 401k, it's a lot better than putting money in mutual funds, for example.
Okay.
But it's the same thing, right? Having a mutual fund portfolio or having a 401k, you can have the same mutual funds like outside of a 401k or inside of a 401k. Investment-wise, investment grades is exactly the same thing. The only thing that the 401k does for you is that it's a governmental, title that gives you the ability to deduct the money that you're contributing towards your 401k. Now, remember, the IRS will always want their money, whether in the front end or in the back end. So when you put money in a 401k, all you're doing is deducting money today against a higher tax bracket to pull the money out in the future to a lower tax bracket. That's another skeptic. Let's get rid of that skeptic. Most people come to me and say, well, everyone keeps telling me that it's better to put money in a 401k because I will be in a lower tax bracket in the future. Again, let's not speculate. Tax brackets have been lower than in the past. Most people don't know this, but the highest tax brackets in the United States have been in the 90s. The highest tax bracket today is 37.5% after Trump came in. The highest bracket before was 39.5%. So we've been in a low bracket actually for a very long time since Reagan took house. And most likely because of the environment that we're in the United States, taxes will probably be higher in the future. So don't speculate that your tax brackets will be lower in the future because nobody can guarantee you that. So my thought on 401k is if you're making over $200,000 of net income every year and you have the ability to put money in a 401k, do it because you're in a higher tax bracket. So it will be good for you to lower your tax impact today, right? But if you're below that $200,000 of income, your bracket is not as high as people that are over the $200,000 income. So it may be better for you to invest in vehicles that are after tax.
Good stuff. So, there's I guess a myth or, thought out there that you have to be employed to invest in a 401k. Is that the case?
Or it has to come from your employer.
Yeah. So that's another
Yeah.
skeptic. Yep. So 401k is an employer sponsored plan, right? So
Okay.
you got to have some sort of corporation for you to offer a 401k. But here's the thing: if you're a self-employed, you can actually have a solo 401k, right?
Mhm.
You can also have a SEP IRA, or you can simply have a traditional IRA.
Right.
So and by the way, everything I just mentioned, same tax treatment. They're all basically very similar to each other. The only difference between one and another is the thresholds of contribution. There's certain one, the IRA, for example, you can only contribute up to $6,000 per year if you're below the age of 50. If you're above the age of 50, you can do catch-up contributions and contribute up to $7,000 per year. In the 401k, you can contribute up to $19,500 per year as an employee, or $22,500 as an employee that has over the age of 50 with catch-up contributions, right? So the only thing that changes between one and another is the way they're structured and the amount that you can contribute to. Tax treatment, though, is the same.
If you guys can hear this obnoxious noise in the background, I am so sorry. The time you tell contractors to come at a certain time and they're actually on time. Anyways, I apologize.
I'm gonna say it looked like a little bit of a terror movie with Jason in the back.
Yeah. Anyways, let's move into retirement. What age should someone start preparing for retirement?
I think the youngest the better, but there's not, like we've been talking, there's not a right time to start investing into your retirement, but we always recommend to our clients that the younger the better, because in finance there's something that is called time horizon, and it's just really simple. It's just the easier way we can manage the compound interest to accumulate assets at a younger age is a lot easier. For example, starting with someone at 25 or 30, it's a lot easier to look forward than looking back than someone that is 50 and he started thinking about retirement when he's 50, and he will look back, so last 10 years I made $1 million in my total income. Where is at least 5% of that $1 million? Where is it? So it's easier to start at a younger age, and you don't have to be as aggressive as if you start at a later age.
Yep. Yeah, and also you got to define you got to define your retirement age, right? I think most people, when they talk about retirement, they always talk about the typical retirement, the Social Security retirement age. And in reality, you don't have to wait that long to retire, right? I think you always got to start by asking yourself, when do I want to retire? And once you have that target date, you got to work with a financial advisor to calculate how much net worth will you have to have at that age in order for you to generate the passive income that you would need in order for you to be financially free at that age.
So explain how, I'm very interested in this, but life insurance policies and how they can benefit you financially. I've touched on this a little bit in my younger days, but I wanted to kind of have you guys briefly kind of highlight that.
So first of all, life insurance should be bought with the intention of leaving money to your heirs, right? That's life insurance definition, right?
Mm-hmm.
You got to have beneficiaries for that life insurance. So
Mm-hmm.
I would say that your life insurance policy needs to be reviewed at least once every 2 years, because things change in your life. So I would say that the first thing is you need to figure it out who depends on you financially, and how much do they need from you if you were not here today, right? And I'll give you I'll use myself as an example. I have 2 children, 5 and 3. My wife doesn't generate income today. Probably will start generating income next year. You know, she was taking the hardest job of this world, which is being a mom. And she's gonna keep being a mom and you know, work probably in the corporate world or whatever she decides to do to bring income. And you know, I call her Wonder Woman, you know, because if she's able to do that, then I feel lazy myself, you know, all the time when I see that. So first define, you know, if something happens to me and I'm bringing, let's just say, you know, $100,000 to $200,000 of income per year, and I'm gonna have to replace that income if I'm not here, right? And an easy calculation, it's not a financial calculation, it's more of an easy calculation. Is, well, if my kids are 5 and 3, I would want to make sure that my kids would graduate college, you know, and then they're on their own. And also I would want my wife to also have, you know, a little bit of net worth on her side for her own ventures or whatever she decides to do. So in that case, I would want to make sure that I give them, you know, an income between $100,000 to $200,000 per year over a 20-year period, right? So that way my kids are out of college at that stage. And then I would want to leave probably $500,000 to $1 million to my wife for her to start whatever it is that she wants to start. So when you do that math, you're going to end up with a life insurance death benefit of right around $3 million, right? And a lot of us sometimes look at $3 million and we were like, wow, you know, that's a lot of money. But, you know, to be honest with you, think about it, right? If you're making $100,000 a year, you know, you multiply that over, you know, 20 years, that's $2 million, right? So the 3 million is not that far from that. And like I said earlier, right, it's better to leave more than less, right? And I can tell you that for clients of ours that have passed, you know, unfortunately, and that now we're managing their you know, their kids' assets. And trust me, you know, every time that happens, I'm always kind of not blaming, but I would say, and I wish I would have just told them to buy that extra $1 million term policy that would only cost them $30-$40 a month, right? Because it's a lot easier and a lot better to manage when you have more money than less money.
We lost Jess. I think her battery died. So do you guys offer free consultations?
We do.
So, you know, we've gotten a lot of great information. It seems like everybody's situation is different and unique, and you did say you kind of customize it. So do you offer free consultations to someone so they know how to get started?
Yes, and I can explain the process really quick that we take our clients through. Very first meeting, it's a very introductory meeting. We only need like 30 minutes. I think it's just to get to know each other. Yeah, I always say 30 minutes, but sometimes it goes over that. And it's just to meet, have a conversation, see if there's a little bit of chemistry between us and the potential client.
Definitely.
And then we also gather some data from them, right? Like, what are the cash flows in the household? What is the current balance sheet? And based on that, and we will design a plan, right? You know, Willie and I will sit down, we'll do the math behind things, we'll figure it out, you know, what do these clients want to do? And based on that, and what do they want to achieve? And then we put a list of to-dos for them. And of course, part of those to-dos could be things like purchasing life insurance or purchasing disability insurance. Some other things could be, well, start saving money in a cash account first, and then move into mutual funds. Other type of clients will come with a already pretty set, you know, here is my $2 million real estate portfolio. I feel like it's not working very well, so I'll ask them to send me, you know, property values, property rental income coming from them, net and gross. And then I'll do like an analysis of what's the rate of return that they're getting from each of these properties. And I'll basically tell them which ones they should get rid of and which ones they should keep long term. Because again, I think there's a lot of clients out there that purchase real estate for a long period of time, and they never really check into each of them just because they feel good having 10, 20 properties. But sometimes out of those 10, 20 properties, some of them are not giving them what they should be giving them. So it may be better to just replace them with another property that can give them a better rate of return.
Is there a such thing as a client that's too small? So let's say you have somebody with just $10,000 in the bank that wants to do something with it, and you got somebody with your $2 million in the bank. Is that 10,000 person still in a position that they should be contacting you and start planning?
Absolutely, and that's why we have a team. So Willie is a financial advisor just like myself. I just have a little bit more experience and more licenses than Willie. So I would say, and we have a team of 14 financial advisors in our team here in Orlando, specifically our team, like Willie and my team. Additional to that, we have staff. So we have right around 5 people on payroll, helping us do financial planning for all of our clients. So yeah, there's no too small of a client, right? Because you never know, right? Sometimes you meet a client and 2 or 3 years later they win the lotto, right? Mm-hmm. And then that's when financial advisors are going after it. We don't believe in that. We believe we'll help anyone that comes to us, right? Maybe they won't be meeting with Felipe because I don't know if you noticed already, but I try to go after very complex financial planning issues, right? And that's where my time is mostly being focused on. But for example, if it's a client with $10,000 in savings, they got rid of debt already and they're looking to build financial wealth, I mean, there's plenty of us in the team that would love to work with that person and grow them over time, right? And they'll spend quality time with them. And that's why we have a team, right? Because there's a certain equation between time and money and capacity, right? And if it was just Willie and I, our capacity as financial advisors is right around 100 to 200 clients, right? So we couldn't serve a whole community if it wasn't for the team that we have.
All right, awesome.
Yeah, I have a question. So how do you stay in front of your clients? That was kind of off the cuff, Jen. I just was curious.
How do you
stay in front of your clients? Like throughout their financial plan, how do you stay in front of your clients?
You mean like a head?
Well, yeah. How do you build that relationship and keep it where they're only working with you and you're in front of them all the time?
Got it. Like, okay, so sustaining the relationship.
Right.
I think we use different words. We're in different.
I'm sorry. Yeah.
I would say it depends on the client. There's clients that like the constant touch. So we have a master schedule. We do that every year, and we figured out, what are, certain clients want more constant touches. So we'll do, phone calls once a month. We could do quarterly reviews in person now through Zoom. So it just depends. I would say there's clients that like the constant touch, and there's clients that they just want to meet with us once a year and just do like a master plan for the year and just execute on it. So it just depends. I think everyone is different.
Yeah, there's people that they want to talk to you every 3 months, and there's people that tell you, don't call me until the end of the year. It all depends.
That would be me. I wouldn't want you to see how many shoes I bought until the end of the year. One time only.
Well, if you start a business of shoes and you're buying and selling them and making income out of it, then I would have no problem.
Okay, like I
don't mind.
Well said.
Guys, this has been awesome. I have learned a lot. Definitely want to set something up with you guys. for those watching that are also interested in setting something up or getting in touch with you, how should they do so?
I would say either a text message or an email. If you want, my phone number is 407-325-0426. And my email is felipe.navarrete@nm.com, which is right there. So either an email or a text. The best.
Same for me.
Awesome. Well, we greatly appreciate you guys taking the time out of your day to be here with us this morning and
Yes,
educate us.
thank you.
Thanks to you guys for having us in your show.
Absolutely.
Lots of great information. Thank you.
It's been fun. If you guys want to have us again, there's probably more topics out there, like asking
For sure, because we definitely could have taken another hour. For sure. Yes. Well, again, thank you guys so much, and I hope you guys have a fabulous weekend.
Thank you.
Thank you too as well.
Bye.
Thank
Thank
you.
you.
Bye, guys.
Well, I definitely need to reach out and get my ducks in a row. So that was some great information.
Yeah, let's look at our commissions. Let's look at that business coming in and get a plan together so we can, I don't know, buy more shoes, right, Jen?
Oh, for sure. and maybe leave a little to the kids,
Yeah, just a little. But it was great. It was great this week. I'm hoping that everyone got something, just a nugget out of this great information. And that's what we're all about, trying to really just give you guys something back in return and give value, because Jen and I really care about our community, small businesses, and just making you better.
Education and for sure. So thank you everybody for watching. If you have a topic for a show idea, or if you are a small business and like to be featured, please reach out to either one of us. Our email addresses are on the screen, or you can find us on Facebook, send us a message through our page. However, we love the feedback, and we hope to see you next. Have a great weekend. Bye.
Bye, guys. Have a great weekend.